All right. Good morning, everybody. We're going to get some economic data over the next few days. GDP today, it's one of the big ones. A little bit of job numbers, not the big job numbers. Non-farm payrolls is the one that we would really want. But any jobs data will go to the heart of the Fed and its mandate. Hong Kong up the most, which isn't saying much at 0.25%. Spot Gamma yesterday mentioned in the PM edition of their founder's note that they didn't really have a good reason for the sell-off yesterday. No specific catalyst that they could point to. But one of the things they touched on was that they had some potential insight that it might have been due to the moves we saw in the yen yesterday, and that might have had something to do with it. They left it open, saying they're just not sure. There wasn't a specific reason, but there also wasn't a lot of longer dated options flow causing it, which means it can flip back again. We're not looking for like a big bear market sort of sell off that's going to continue to go to the downside. And it is worth noting, we do have Jackson Hole August. It's every August. And Powell's been known to throw a little bit of a curveball. Try to bring up the Jackson Hole economic calendar. Looks like it'll be on the 23rd this year. One thing I wanted to point out and why we're on this screen is this move in the dollar in the overnight. We saw this sell off in the 10-year. The move in the dollar, even though it's not as big, there was a similar move in the NASDAQ and the ES and in US dollar Japan. And they all are just kind of sitting and hovering around their lows. We're not seeing that inverse market, where the dollar goes down and the S&P and NASDAQ go up. In fact, when it bounced here and started to go up, so did the NASDAQ and the ES. So just stop my mouse on that spot at 4 o'clock. Remember, the kill zone is between 2 and 4. So we got the move down, and at 4, we get the trigger. With my mouse sitting there and I don't move, look at all those 4 charts, the ES, the NASDAQ, US dollar Japan, and the dollar. All 4 of them moved up at the same time in that correlated state. The point here is things are still off, right? They're not the normal way of doing business. So just want to approach with a little bit of caution. Japan down almost 1%. The NASDAQ, S&P, the Dow, and the Russell all just sitting flat, basically unchanged on the morning, ready to move in either direction. $8:30 today is going to be the biggest one. Durable goods, some job numbers, and then GDP. So kind of a big deal. Of course, Friday we got PCE, and that's no joke either. And then next week, even though it's not showing here, Monday, we're going to get some of the QRA data. It's a two-part event. Monday, we'll get some of the QRA on Monday at around 2 o'clock, I believe. And then Wednesday at 8:30, we'll get the other part of the QRA. And also on Wednesday, we have FOMC. So next week's a doozy. I'm pointing that out because, if you're swing trading, this is a really big deal. This is really important. And it doesn't show up on here. QRA is just one thing that isn't really covered much in the public space. And yet it's a really big deal. So kind of want to know when it's coming. We got Christine Lagarde today too before Europe closes at 11:30. So she'll be starting at 11. Normally, if Europe has caused us to move, if it took us up or took us down and then they close at 11:30, we can often see an unwind. But when it's this close, she's going to start talking at 11. They close at 11:30. We're going to get auctions at 11:30 and 1. It could be a busy afternoon. This is important when we're thinking about those afternoon 0-day trades. A lot of afternoons we're just free and clear. There's nothing really to bother us and give us an interaction, but not today. We can have a pretty busy afternoon. Another thing about that sell-off yesterday is it was really controlled, neat, and organized. It wasn't like a mass exodus with everybody screaming and frothing to get out. It was just a nice, clean, orderly sell-off. And there's not even a big enough reason yet. There was some discussion about how AI is disappointing and there's all this money being spent on it and we're just not seeing the returns. We haven't had enough earnings released yet showing that failure for the market to just throw up its hands and vomit out all of those AI positions. So I agree with Spot Gamma. We just don't have enough information on the why, but we needed a good shakeout, right? And I like how they kind of summed it up, how correlations that were just way off track are now back, and the concentrated risk is ending and we're seeing a more broadened market. That's what we need, right? If we're going to get a second half of the year rally, we got to have everything that was left behind in the first part of the year joining into the rally. Just start with the ADR. We don't have a market maker move. They're not hedging yet in the front. We're already at the ADR half, which implies we could go to the other side by the end of the day. We were at this same spot yesterday, but we had been crisscrossing back and forth through it, which is a little different than where we're at today, where we keep bouncing across the top of it, but we're still there and it still counts. The fact that we haven't already left and started moving the other direction is a little bit of a signal, just like yesterday when we got there and we kept cutting back and forth above and below it. Because we haven't left the zone yet, it still means that we could come down lower, just like we did yesterday. But a break above our own Globex high gives us a clear target up to 55.11, which is a cog line. It's another one of those 11s that I keep talking about. It's funny how that number just keeps coming into play. But that would be our upside target if we can get a new Globex high. If we cut through that, which would get us through this, and we'll see it in the volume profile here in a minute. This is a big area we're going to have to deal with. But if we can get through that, which gets us through the ADR half, then we can go to the ADR full. And the target would be yesterday's RTH open. I know the open is not as popular as yesterday's high and yesterday's low, but market open is a really good pivot. And it's 55.50. Just lines up that way, right? You got to love it. There is also the consideration of the halfback, and there's a couple of different ways that you can do this. So some people like to measure what we have, and the halfback would be right there, 55.24. That's one way to do it. No argument. But the other argument would be where we ended on Tuesday, not where we started in the Globex, right? But when we do that, when we line it up this way, we actually get a halfback that lines up right into that midpoint of yesterday. It's the ADR of yesterday. So there's no wrong way to go here. You can also just do a halfback on the RTH of yesterday, not even messing with the Globex at all. That lines us up at 55.06, a little bit of a front run for the upper ADR half. And throughout the day, we have to shift these levels on which ones we're focused on anyways, because when we get past one zone, we still need to know where the next zone is. Either way, any move to the upside is going to have a lot of resistance. Get through our own Globex. 54.92 is a cog line, and that'll be a right on the other side of this pivot. Liquidity resides on the other side of the pivot, and it's a cog line. So that's going to be a difficult level to get through, that 92. But if we can get through it, then we'll go to the cog at 11. The full ADR, yesterday's open, level by level. Otherwise, taking it in the other direction, we've already got the ADR half down here. Measure our own Globex. $54.11 is 100% of this move plotted to the downside, and it's the other side of the ADR full. We can take that bigger stance, measure all of yesterday, and plot that to the downside. That'd give us downside targets as well. You can also just target yesterday's RTH, and that would give us smaller levels, but levels also. On this one, we've already got down there. That's the 111 warning center. We got right into it and got this tweezer bottom, came right back out. Now we're getting these higher lows, but we're still getting lower highs. So we're starting to wedge into compression. But we've got clear targets to the downside. If things get a little wild, then 54.11 cog line would be my extreme target. Like yesterday, we needed an extreme target. And the spot gamma level was minus 2.8. It only goes to minus 4. So that's a pretty extreme negative number, which implies if we break down that we could continue to go lower because we're in negative gamma and the dealers are in negative gamma. And to get back to delta neutral, they have to sell into selling. The more we fall, the more they sell to get to delta neutral. But the more they sell, the more we fall, and they're no longer in delta neutral. Looking at the central pivots, I think it helps to have that cloud for the week showing. There we go. There's the weekly pivot point, this very large cloud that's now obscuring everything. We're firmly underneath it, but as you can see, we're also a long ways from it. No, a delta neutral is their position stance. So say you're going to build an iron condor, for an example, right? You're going to build an iron condor and you want to build it around price. So you've got price, it's been doing its thing and it starts to go sideways. So you build an iron condor and you've got your call spread up here, your put spread down here, and price is just about in the middle of your condor. That's what we would consider a delta neutral position. Your risk is balanced between both sides. Then if you're a dealer and you don't have to pay commissions, you could just sit there and keep rolling your positions up and down, up and down, up and down, up and down for every gyration and move in the market, staying as delta neutral as possible. You don't have any long deltas, you don't have any short deltas. You're about as neutral as you can get. They want to stay about as neutral as they can get. They don't want risk to the upside or the downside. They just want to make book for you, being a market maker, without assuming any risk. So they want to stay as completely neutral in their position as possible. Unfortunately, when we're in negative gamma and we're falling, they start getting a lot of deltas. They got to unload those deltas somehow. So they sell into the selling, which aggravates the selling, and we sell even more. That's why we didn't V bottom and bounce back up yesterday. Typically, if we would fall, they would be buying into the fall, and that would help slow us down. And then it also rebounds us and pushes us in the other direction. Instead, since we were in negative gamma and we were falling yesterday, we just kept falling and kept falling and kept falling because they were selling into the selling. We are quite a distance from that weekly pivot point. And as much as I've tried to quantify this over the years, I don't have a really good answer for how far away is too far. But this is just about it. Could we go a little lower? Yeah, absolutely. I think we could wick down a little farther, and we could even just straight up drop down a little farther and say get into this S2 level, 5411 cog line. There it is again. Those cog lines just keep showing up. We could do that, but that would be very extreme, and I wouldn't expect to stay there. I would expect that V bottom that we were just talking about at that point, taking us back in the other direction. You know, a lot of times we ask the question, are we overbought? Are we oversold? Have we moved too far? And the answer generally is nope. Today, if we get down into this 5411, it will have become too far. We will expect a mean reversion. This will be a really great place to take a low risk entry long, even if you're just using Friday's options. And the cheapest risk-free way to do that, just put on a butterfly. Butterflies are crazy, crazy cheap, and they have an amazing payout. So, you know, it's about as good as you can get. You could just buy a call, or you could sell a put and buy a call, just sell the put, sell put spread, whatever. But the butterfly is definitely the cheapest route and the lowest risk route. On the week's profile, which is what we have here, you can see where all the concentration of the risk is. That's not helping us out at this point. It just does show that that 56.11 is going to be an issue if and when we get back up to that level, but we're nowhere near that level. And we don't have enough of that down here to suggest we're going to turn around and go back up yet. So we kind of need this sort of juice down here. Otherwise, this is a really good example of a classic P-shape profile with the point of control sitting in the upper area. We have elevated volumes this morning, but we still do not have a market maker move, which on one hand makes sense. If they're trading, they're generally not hedging. Or if they're sitting out because they're worried, then we generally see that hedging. They're trading. We're getting some really elevated volumes this morning. What I keep coming back to is we're not going anywhere. What do we call an iceberg, right? When price goes down into a level of liquidity and all these orders are coming through and price ain't moving. That's an iceberg. At what point are traders going to get frustrated that they're doing all of this work and they're not getting anything for their effort? That's a lot of trading. Where the heck is the price move that comes from all of that trading? Because we're not getting it. It does imply, though, that we're building up a lot of structure here. And when the move comes, which could go either direction, it very likely is going to be an explosive move. But so far, they're not hedging. They're just straight up trading. The 1-day standard deviation is 63, call it 64 points. The daily expected move is 53 points. And the 21-day average daily range is 57 points. Wait, let's go back. We got levels to talk about. So we do got those spot gamma levels. We're underneath zero gamma. We're underneath the volatility trigger, and we have a new put wall, or maybe it's just the put wall, 54.40. We were underneath SPY's put wall yesterday, and I don't know. I'm looking at the founder's note. The PM doesn't have the rolls, so if they've rolled this, we still need to see the AM. Seems to me like that put wall is lower. Just say it that way. Maybe it's not. That's why I like getting the founder's note. I don't have to guess or try to remember what it was yesterday. Either way, that's where it is now, 54.40. So that's going to act as a little bit of a support. If we do try to make that 54.11 drive to the downside, we are oversold. It is extended, and it does owe us some mean reversion back the other way. Whether we're going to get that move first or we're going to dump down just a little bit more, like a capitulation low is what they call it. On the other side, it'd be a blow off top. That remains to be seen. And with the data that we have this morning, we very easily could get one more hurrah to the downside first before we flip and make that run back in the other direction. And the put wall is going to be a part of that flip. It's where we would expect them to monetize their puts. Yeah, oversold is a good word to use. I mean, I've never liked overbought and oversold as a phrase because it gives newer traders the wrong sense of what price should or could do. I really hate that phrase. But when we think about how far from the weekly pivot we are, when we do that enough, when we expand away from that weekly pivot point so far, we get to this point where it's nearly impossible to go any farther, right? We just get to this point where we just can't go anywhere else. And we start going back in the other direction. We've seen it time and time again. And I don't have a way to quantify it. I've tried to build the indicator to measure how far from the weekly pivot we are when we expect this to finally reach its peak, and we just can't get any farther away from that pivot. And the indicator is worthless. I've tried it over and over different ways, and it continues to just not show really good levels. And I can show some places where we've made big moves away from that weekly pivot, but normally it's not this big of a move. And we started the week already pretty far away on that week. Anyways, most of the time though, we get too far away from that weekly pivot and we just can't get any farther away. It stalls again and again. So you can say it's overbought or oversold, but I would say it's just from the options world and from the market makers and the dealer gamma and everything else. If we go any farther, we're going to get into flash crash territory, which spot gamma kind of touched on too, that there's nothing down there. You get below that put wall, there's nothing there. And then we can really expand fast, very fast. I'd rather believe that we would V bottom and rebound than think of the idea that we're going to flash crash. But it is on the table, right? It's totally on the table. The 10-day, 30-minute volume profile point of control hasn't moved. We're not expecting it to move anytime soon. It's still going to stay there for a while. If we did rebound back up into 5,600 area, we could build that zone out as we lose more of this 5,650 area. But other than that, there's nothing showing up that would move this point of control anytime soon. So that's likely to be its location for at least the rest of this week, maybe even to the start of next week. The VPOC that we put on yesterday didn't last. We ended up taking it out. So that one's gone. The one that we'd had on the chart for quite a while, that 55.33 cog line of VPOC, we took that one out and we didn't even slow down on that one, just ran right through it like it wasn't even there. And then a real old one from 5,500 was taken out yesterday. And now that one is gone. We don't have a new VPOC to lay out on yesterday's price because we cut through that in the overnight considerably, lots of times. We've got a disagreement here between these two. More trades happened up here at 54.84, but more volume has happened today down here. That's why the point of control is in two different locations. We would expect this to balance out a little bit, but we're not seeing that balance out yet. And look at yesterday's profile. We were talking about how on the week, we still have the point of control way up here. But on the day, we have the lowercase b of yesterday, and the point of control is down here. That level, even though it's not a VPOC, is going to be a really important level in today's trading if we try to make a move back up. It's where the greatest amount of trading took place yesterday. Even in that 1 hour of time frame, that's where the greatest amount of volume took place, right down here in that 1 hour. So if we revisit that level today, it's very likely that we're going to have a hard time getting through it, whether it's buyer's remorse, unfinished business, whatever you want to call it. there's no bias to the statement that says that's where the greatest amount of trading took place, because it's fact. We can see it. So use that fact today and say, well, if we go back there, there's very likely going to be an area of interest because that's where the greatest amount of trades took place. If it was interest to people yesterday, it very likely is going to be interest to people today. 5484. And it's not a VPOC line, it's just a POC, right? Just a regular point of control. Make it stand out. So it's easily recognized as being something other than the norm. If we go back up into that level, there's likely going to be a reaction out of price, as there already has been. And where we spent a lot of our time last night, there was the greatest amount of trading that happened so far today was up at that level. That's why the TPO has got the point of control up there. And we try to quantify, have we moved too far, too fast? And does it owe us any sort of mean reversion by looking at the 10-day and the 10-week? This is where I tend to ask that question. Does it owe us a move in the other direction? I don't really like the overbought and oversold language. But you got to recognize consistency. When we get around 2% underneath the 10-day moving average, it tends to be where price stops falling. That doesn't necessarily mean that we rise, right? We can stop falling and just chop about. So we need a correction from the correction. We've already made the move down. We're a distance from the 10-day, 1.9%. At this point, we would expect to stop and pause, digest, and let the 10 come down to us, which would decrease our distance from the 10 and be a correction in time. Or we flip around and run back towards the 10, and that would be a correction in price. And we either way close our distance back to the 10. We've gone lower than this. There's plenty of examples where we've gone 2.5, 3, 4, 5. But we're not expecting that sort of move, right? Those were bear market moves, and we're not in a bear market. So our typical average move from January 2023 up to where we are now is getting around 2%, and we're there. We could go a little bit more, which we already talked about, getting down into 54.11. I mean, we could get down into that level. That would be our overshoot. Give us, a -2 plus some. And then we flip like a little bit of a V bottom and go back the other direction. But this is the daily, and we want to swap over and see how far away we are from the 10-week. We're barely below the 10-week. I would say we're at the 10-week because crisscrossing above and below it 1/4 of a point is nothing. That's like the center of the basketball court. We could move 4% to the upside away from the 10. We could move 2.5, 3% to the downside away from the 10. We're right in the middle of the game here. So on the weekly, in the bigger picture, we're not overbought. We're not oversold. We're not outstretched. It doesn't owe us a move in either direction. We're just right back to the mean, basically. You could say we had gotten overbought and that we're now just we're just back to the mean. Maybe we got ahead of our skis there a little bit and we needed to pull back. Here's the start of the new month. That's the 3-day open range low, and we broke that. We're underneath it. Put that in a line format. It's 5,500. There's also the consideration of, you know, anchored VWAPs. July's anchor, June's anchor. I've don't really have a lot of trust with those when it comes to the futures. It seems like those anchors work a lot better on the equities, Apple, Google, Microsoft, that sort of stuff. The monthly anchors on the futures just don't seem all that useful. Not to say you wouldn't want to look at it maybe once in a while, see if there's any sort of assistance there, but so far I haven't been impressed with what I found. We are on the edge of the week's expected move. This is how far we were expecting to go for the entire week. We're already there. I mentioned the other day how we can go to the edge in a single day, from the midpoint all the way down to the bottom, or even from the top all the way down to the bottom in a single day. It's happened before. It'll happen again. Did that. We're there. We now have to have the consideration of, are we going to close for the week outside of this box? 80% of the time, the S&P closes inside this box. This is a 1 standard deviation range, so it only owes us a close in the box 68% of the time. And the S&P does that really well. It does it so well. It has one of the most accurate expected moves that it typically beats that and does it 80% of the time. But it can close outside of the box no matter what the numbers say. So even though our base case argument would be by default that we would close inside the box, just like last week, we don't have to close inside the box. We can close outside of it. And so far, we're outside of it. Getting out and closing on Friday outside of it 2 weeks in a row, it happens. It's the third week is where I'd start to get concerned. If we get 3 weeks in a row where we close outside that box on Friday, then I'd start being a little more concerned about the swing trades. The 29th and the 31st. The 29th is she'll announce the proposal at 2 p.m. and the 31st she'll give the results at 8 a.m. or 8:30. I think it's 8, but I'll update you then. Which means when on FOMC week next week, because it'll be next Wednesday in the morning and in the afternoon, we're going to be getting data. And typically on an FOMC week for Monday and Tuesday, we would expect a sideways day, 2 days in a row, iron condor plays, a lack of movement, kind of holding steady into FOMC. But because of QRA proposal Monday morning or Monday afternoon, that calls into question the idea that we're going to go sideways for that Monday and Tuesday. The QRA event is impactful. So, I know it's not a popular one that a lot of people know about, but it's important. It's one of those big ones that matter. So just hiding the moving averages here for a moment. Some of the largest turning points in the markets, like that low when we were in that bear market move, and everything changed on that QRA. And we just ran nonstop, and the QRA that we got next propelled us even farther. It brought us out of that 6.5% pullback, even just this year, shut us back up to the upside, shut this move down and took us down. Just these QRAs, sometimes just like an FOMC, the QRA can give us data that the market's been waiting on, and then everything changes. And then other times the data is just like no change, keep on keeping on, and the market doesn't give a big violent reaction. So we could get QRA and FOMC that just carries on what we've been doing, and then we don't get a big change. It could be that way. Or it could be one of these major turning points where everything changes. We had that 6.5% pullback, and then we were just kind of working it out when we got QRA last time, and up we went. And here we are, pretty good size pullback. Not quite as deep yet, which is why I think we got some time to get a little closer to that 5,400, get this a little deeper, try to recorrelate the market so that, the rising tide effect starts to lift all boats. We get QRA and we make another shot at it. My concern is years like 2018 or 2019. I think 2018 works pretty good for this example, where we didn't do anything, right? We started the year at the high and we just chopped about underneath it for the entire year until October. And then we still didn't really get much beyond that initial January high. Or take 2019 when we started in the dirt. And once we got up to those previous levels, that was just about all we got. We could have set the high for the year, and then we can just spend the rest of the year chopping about. Not saying we're going to head down into 5,100 or even 5,000, but we could spend the rest of the year never really getting beyond 5,750, which is fine. I mean, we'll find something to trade every day, but it would certainly call into question, that nice expansion that we've been seeing across the board. So we'll see. Got 15 minutes for the data we're all waiting for this morning. And as we would expect, we're very likely not going to see a lot up or down. Semis are down, more of a knee-jerk reaction than anything else. They're still on a 5-day down more than 5%. Jets are still down, which they got hit pretty hard on that CrowdStrike issue. Bitcoin is down, still up over 3% though on a 5-day. Gold miners, emerging markets, so China's down. It might have been easier just to look at what's up, and nothing except the VIX, which I like. Spot Gamma laid that out a little bit. The VIX has changed quite a bit with all of this really heavy 0-day trading that we have now compared to what we had, say, even 5 years ago. And it doesn't make the VIX obsolete, but people don't react to moves in the market by trying to hedge their immediate risk with the VIX. They're using the VIX for known unknowns. That was Spot Gamma's phrase. A known unknown would be FOMC or QRA. it's a known event, but it's unknown what will happen at that event. So a known unknown. People are using the VIX for that. But take a day like yesterday when we were just falling and everybody's like, I really don't have a good reason on why we're falling. Why we're just falling. People weren't necessarily going to use the VIX. Institutions won't use the VIX for that to hedge. They'll just hedge in the futures, or they'll hedge some other way. Retail traders responded by grabbing the VIX yesterday. And Spot Gamma said, look a little farther down the road. If they're grabbing the VIX and it's short term, then institutional traders don't see something big down the road that they're worried about. But if they start grabbing VIX with some duration to it, then it does imply that the funds and the firms are nervous about something down the road, and they're bidding the VIX up, trying to get some insurance against whatever that unknown known is. So we got bonds up, really nice move in bonds so far this morning, but we're just getting back to year-to-date VWAP, and we've been crisscrossing back and forth through that anyways. Financials, but they're not even up enough to meet our criteria, so won't even count that. Things that are down, we got silver down the most, a significant gap down from that range that we've been holding for a long time. It finally broke. Where are we going? To the anchored VWAP. Let's get there first, and then we'll see. But that's a really good starting point for a target to the downside. Gold miners, really large gap down, over 3.25%. The eventual target would be back to the year-to-date VWAP, but there's some support along the way in there too. So it won't be such an easy target like silver was or is. Same thing with GDX. Big gap down, 3%. It's got a halfback that it needs to deal with. Then this low, then the anchored VWAP. I don't think those are going to be, easy trades by any means. I think it's going to take a while to make that sort of move. Big gap down in Bitcoin, farther away from the year-to-date VWAP that's already underwater. Crude, we're coming back to that target first. Let's get to the year-to-date VWAP, and then we'll see. I like the idea of reciprocation again. So whatever we got on one side, we get to the other. Maybe a overshoot into 72. Southwest, I think it was. One of the airlines was in the news this morning. They're making some changes to their approach. They've got activist investors that are taking over their board and making demands, and we could see some changes eventually, but not right away, right? And this is just the ETF anyways on jets. At some point, we're going to catch a rebound, but I would look for reciprocation first. Measure the top side of VWAP, plot it to the downside. It may well just line up at this 17.5 down here. Cloud computing is getting some moves. That might sound like just another day, but usually cloud doesn't get a lot of movement in the pre-market. It'll get these algo prints, but not really like a full candle. We're getting a full candle. So we're getting some flows in cloud computing. That is kind of a squished, ugly head and shoulders too, but we wouldn't want a head and shoulders after a really big drawdown like this. We would want head and shoulders to be up at the tops, right? Inverse head and shoulders at the lows, typical head and shoulders at the highs, not the other way around. So it is forming one, but it's ugly and squished. The more messy a pattern is, the less likely it's going to be recognized by others. Then it's the whole chicken and egg. Assigned seating, that's right. That was the phrase. And you know what? I've traveled on airlines that if it wasn't really busy, they would just say, oh, you could sit where you want. After we were in the air, they would say, go ahead and just change your seat, sit where you want. But then I've been on other airlines where they didn't care. They were just like, that's your seat, you stay there. Whatever. You know, yeah. I don't know. Unless there was people complaining about it, why would they take it away from people? That seems like a perk to me, to be able to get out of your seat and go to a different one if you want to, especially once you're in the air. SMH, we still got a nice target down to the year-to-date anchored VWAP. Oh, that makes sense. The China ADRs, we cut through that year-to-date VWAP. So we're going to expect a little reciprocation on the bottom, and then very likely we'll come back to it again. Just like how above we kept ranging away and coming back. Well, now that we're below, we'll expect to range down and then come back to it again eventually. Emerging market still has room to fall, just like semis do. That year-to-date VWAP is kind of the target on a lot of these. When we ask, well, is there still room to fall? Oh yeah, emerging markets, semis, cloud computing. Well, okay, they're already under it. A lot of room to fall on these, but there is a target, right? It's kind of the idea. We're just looking for X amount of a pullback and then stabilization. So we're not expecting some big, massive sell-off. And we've only had two mega cap earnings, Tesla and Google. And sure, Google got whacked because they spent too much money. But it seemed like Tesla got whacked for reasons other than spending a lot of money on AI, right? Which is what this whole thing of we're seeing selling because AI isn't as profitable yet, blah, blah, blah. Well, we haven't even gotten started. Let's hear from Microsoft and a lot of the other companies. And I use Microsoft's AI constantly, constantly. But you never hear them mention that. They'll say they're comparing Google's AI to Meta's AI, and nobody mentions Microsoft's at all. Looks like a reasonably decent day. Expect some stability. Expect to hold the line. Even if we get some negative data, I would expect that drop down, like we were talking about, into say 5411 area, and then rebound it from there like a V bottom. We could overshoot into like 53.50, which would be this 20-week moving average, but that seems extreme to me. I really don't think that the data we're going to get today would warrant that kind of a move today, right? Like it's not that big of news. The white dotted line here is May. Is that April? That's May. May's anchored VWAP right there. So 54.32. No, 54.26. 27. Whatever. Close enough. Cut underneath that. And then 54.11 cog line. And that should be just about as much of the move as we get. 6.5 to 7%. 7% if we wanted to take it extreme. 53.20. Yeah, that's a little extreme. That'd be April anchored VWAP. I don't expect that much. Certainly not today, but we're talking about how far could we fall before we finally see the flip. 6.5 to 7% is the standard pullback before the next leg. So at worst, we're looking at 5,300. For today, I don't expect to even touch 54, maybe 54.11, then a V bottom. We got to see the next leg up, right? Even if it's just a little bit of a dead cat bounce into 50% of the last leg. That would make perfect sense. So we're looking at it from the idea of just measuring that. That's 54.40. Then measuring that, and that's 55.86. Your two half back levels. The thing is, this one don't count yet because we haven't started to come up yet. Until we, pause and start coming up, then you really don't want to measure that zone. So this one's not technically valid yet. Still, it's better than nothing. Yesterday's candle's a big deal. So if we do rally back up through our own open from Globex last night, mark yesterday's midpoint. It's 55.23. That's a valid mark, and that one's going to be an area of concern. Got 4 minutes till we get data. Everybody be careful, be safe, have a good day. I'll see y'all tomorrow.